Recording in progress.
Good evening, ladies and gentlemen, online and in person. Welcome to Regent Business School in Johannesburg, Auckland Park, where we are going to be analyzing Minister Enoch Godongwana's latest budget speech, which was delivered in Cape Town earlier this afternoon. And we're hoping for a lively conversation, which will really be something that will be interesting to everybody in person in particular. But if you are online, you're more than welcome to join the conversation via Zoom. Use the raise hand function if ever you've got a question, and we'll make sure that you are audible to our listeners and our viewers online. I'm also not alone. As usual, I'm joined by a very esteemed couple of guests. In particular, we're very excited to welcome back to our Regent Business School family, Mr. Nadir Token. Mr. Nadir Token is the head of investment consulting at investment consulting strategy at Alexander Forbes. Just to give you a brief history of what he's about, if you need a reminder, after having obtained a Bachelor of Economic Science degree and a BCom honors degree in finance at Wits University, Nadir then entered the asset management industry. He's then been in asset management since 2011, performing the roles of sales manager, research analyst, investment strategist, portfolio manager, investment director, as well as chief investment officer. While serving as a portfolio manager and chief investment officer, Nadir's projects have won a number of awards, including 3 Raging Bull Awards and 2 Morning Star Awards. Nadir has written many market research and investment commentary pieces over the course of his career, and he's also garnered 4 years of experience in being a lead portfolio manager for both a global equity fund and a global multi-asset fund, and 9 years of total experience prior to taking on his role that he currently occupies. Shortly after taking on this role, Nadir was approached by a large US-based global multi-manager to be a technical resource on the ground for South Africa. It's my great pleasure to welcome back Mr. Nadir Token to our offices and our campus in Johannesburg. Nadir, it's so nice to see you again.
Yeah, thanks for having me. It's always great to do the session. So
lovely, thanks Nadir. Yeah, looking forward to your contribution as well. I'm equally excited to welcome somebody new to our panel, a gentleman who perhaps in finance circles requires no introduction, but certainly new to the Regent Business School family, Mr. Kanyani Motlao. He's a senior portfolio manager at Terebinth Capital. Kanyani is a seasoned senior portfolio manager at Terebinth, and he specializes in managing listed property funds with a background in macroeconomic research. He previously served as an investment analyst and a portfolio manager at Coronation Asset Management and co-managing a property equity fund. His career also includes roles as an assistant economist at the South African Reserve Bank and a trainee economist at the Bureau for Economic Research. Mr. Motlao holds a Bachelor of Science degree with honors in economics from the University of Cape Town, where he also majored in economics, statistics, as well as finance. And he also earned a national certificate from Malebo Senior Secondary in 2005. Mr. Motlao's interest extends far beyond finance, where his interests go towards sports and a keen passion for football, Formula One, and cricket. Mr. Motlao, lovely to have you. Welcome to the Regent Business School family, and we look forward to your contribution this evening.
Thank you. It's a pleasure to be here.
Lovely, thanks. I think that there's so much so many ways we can analyze the budget speech, gentlemen, and I think if we contextualize it a little bit, this budget speech is set against the backdrop of a tough economic outlook. We have lots of challenges facing us economically, politically, and socially. We have the issue of load shedding, which just doesn't seem to go away. We have slow or a lack of sufficient economic growth. We have increased global uncertainty. We find that inflation is really placing undue strain on the average South African consumer. There's volatility in markets. And I think as we unpack this budget speech delivered by Minister Godongwana this afternoon, I think that background and context really matters. And I thought maybe that's a good point for us to start, maybe with you, Kanyani, just your view on the challenge that the minister had in trying to deliver a budget speech that stimulates growth, that is in the context of realities that are facing him and our economy, like load shedding and other issues of the like, in an election year, where there would probably have been a temptation for him to position this budget speech in a particular manner that might influence the South African populace towards a particular set of actions at the polls. Just your initial high-level overview and your commentary on the budget speech as a whole.
Yeah, so I think from a context point of view, the fact that, as you mentioned, the global environment, the local environment especially, has been quite challenging. As you'd well know, the growth estimate for last year, for 2023, included in the budget, is about 0.6%. Into this year, it's expected to go to about 1.3%, not too far off from where the Reserve Bank also expects about 1.2%. So within that growth context, certainly from a revenue perspective, you're quite challenged from a budget setting point of view. And if you think then about an election year, the temptation, as you rightly mentioned, is to adopt populist policies to try to convince the electorate that essentially the party that is in power is the right party to still go with. And I think that the minister actually did a relatively good job of resisting those populist temptations in an election year. And I think if you look at the budget from an expectations point of view, the discipline that came through from the minister in essentially saying we are committed to fiscal consolidation. If you look at the estimates for where the budget deficit is coming in, essentially unchanged from the MTBPS. If you look at the GDP trajectory, lower than what you expected at the MTBPS, in part due to some drawdowns of the GFECRA. We can go into detail on that later on. But I think on an overall basis, against expectations, against the broader environment, I think the minister did a relatively decent job of trying to balance all of these trade-offs and ensure that essentially you've got a budget that is essentially cognizant of all of these factors and not essentially give into some temptations, but actually to try to stay the course of fiscal consolidation.
Yeah.
So I think a decent budget overall, given the environment and all those other factors.
Certainly, and I think the word that stood out for me in what you've shared with us is discipline. I think there's lots of temptations. There are political temptations, there are business temptations, there are electoral temptations, and I think the finance minister had a tough balancing act to find in and amongst all of that. And I think if we continue, Nadir, with the idea of contextualizing the speech before we delve into the merits of it in and of itself, we must look a little bit back towards the medium-term budget speech prior to this one being delivered this afternoon, and almost take a checkpoint in seeing whether or not the course that has been charted historically, not only in the medium-term budget speech, but perhaps even the previous budget speech itself and even beyond. Are we on track with the goals that we've set for ourselves historically, whether that be short-term in the recent past or beyond? And beyond that, are we saying to ourselves that the changing economic landscape that makes things difficult to set a long-term set of goals and objectives, how has the minister managed to navigate that level of complexity?
Yeah, so there's a lot to unpack there. So I think that it's probably more in line with more recent budgets. I think the deficit numbers and the revenue numbers have probably disappointed if we rewind to, let's say, the budget from 3-4 years ago. We certainly overshot those targets from a debt consolidation point of view. We certainly, the Treasury probably slightly overestimated growth and revenue collection, despite the valiant efforts of SARS, right? SARS is working with very little from an economic growth point of view. Let's remember that, it was 4 years ago where President Ramaphosa said that in a year's time, load shedding is going to be a thing of the past, right? Yeah. And we still have load shedding today. So the economy has probably drastically underperformed from where Treasury would have expected, I'd say, probably 4 to 5 years ago. And the picture looks quite a bit worse relative to then. And we see now that's played out in the market, right? Our bond yields have shot up. Our currency has weakened significantly. There's been quite a bit of foreign selling out of our equity and our bond markets. So that disappointment has largely come through in the price. What I will say is that Treasury is probably, relative to the more recent budgets, I'd say the budget last year and the medium-term budget policy statement towards the end of last year in particular, we're certainly sticking to the course that was charted there, So our guest here alluded to the fact that the 4.9% budget deficit, despite the fact that there's additional spending that has come through from there, the contingency reserve drawdown is catering for a lot of that. So we're sticking to, the budget deficit we forecast. In fact, debt is consolidating at a lower number. We are chatting just before we went on air. Is in fact consolidating at a lower number than what was said in the medium-term budget policy statement. So that's fundamentally a good thing in the same time frame of the 25-26 financial year. So I think I have to reiterate the sentiment that given how little the minister was working with, from a growth perspective, and we can unpack some of the tax numbers and what's happened to a couple of the sectors possibly later on, but given how little that he had to work with, I think the minister really did a decent job to chart the course of fiscal consolidation. Of course, the population wants more. Yeah. I was doing a panel earlier on today, and the panelists were like, we haven't done enough in terms of creating jobs. We've got 32% unemployment. Where's the job creation? The problem is all of these things cost money. And, you got a chicken and egg situation where we need the economy to start firing before he can do more from a pro-growth perspective. So it was difficult. Yeah. And I think that it was a decent balancing act that he did, that he did, yeah.
Yeah. So I think that, having set the tone, having contextualized this particular budget speech, historically, at least in the recent past, and to the point that Kanyani made earlier, being very disciplined despite many temptations that may have been in front of the minister, getting into the meat of today's budget speech, I think for me at least, this issue of economic growth is probably the underpinning and enduring issue amongst everything that was spoken about. Mm. And the point you made as well, how do you stimulate growth? Growth doesn't just happen. There's certain things that needs to be in place for growth to happen. And there's an environment, Kanyani, that I think needs to be in place for growth to happen. What has the minister done in today's speech to try and promote growth, or to at least put in place some form of environment for economic growth and stimulus to occur?
I'd say essentially following on when, not necessarily just last year's budget, I think you have to look at the administration as a whole from when the current president came into power. Essentially the key thing that South Africa needed was the structural reform to take place. And I think in successive budgets, you've seen incrementally moves to basically move towards reform rollout basically taking place. And I think, without going into too much detail, the Operation Vulindlela framework and essentially the successes under it, including the renewable and energy generation as well, is part of that. And I think it will go some way. It still, I think, still has a long way to go, but I think that's a start. And to that point, obviously last year there were measures put in place where essentially there were incentives put in place for households as well as business to essentially start rolling out renewables. Yes. And I think into this year, especially for businesses, you will have seen that the threshold for that renewable generation that was doubled from the 15 megawatts to 30 for businesses. So I think that increase are essentially welcome. And then alongside, obviously, that the reform on the SOE side is quite fundamental. So the work or the package put forward for Eskom to essentially put on the right path was a start last year. We expected something to come out perhaps on the Transnet side, but I think the broader picture, there wasn't that much detail because they already gave them a guarantee in December. However, at a broader level, there's a lot of work going on behind the scenes around the logistics roadmap, the National Logistics Crisis Committee, etc., to essentially ensure that your SOEs are not just getting money, there's oversight, one, and secondly, you are allowing for more private sector participation. In this budget today, there was also a statement around a comment, a piece of legislation that has been put out for public comment, where you're essentially trying to relax some of those conditions around public-private partnerships. So to essentially make sure that Transnet is able to put third-party providers or private sector players within the rail and port system, and I think you've already seen that in recent weeks as well, where a third-party player was introduced at the Durban port as well. So I think it's not something you can look at in isolation, but just from the beginning of this current administration, in successive budgets, there's incremental work being done to ensure that essentially you get reform progress going. But obviously, the proof of the pudding is in the eating. You can't just sort of tick boxes boxes on a sort of on a spreadsheet. You have to see it actually come through on the growth side. So to the extent that we still at the tepid growth of about 1%, Treasury has about 1.6% growth forecast over the medium-term expenditure framework. That's not enough. You're going to have to see a lot more of these reforms essentially accelerating to ensure that that growth picture actually improves quite a lot to address many of the issues that we have as a country.
Sure. Yeah. And again, you know, there's a couple of things that stood out for me. Your commentary on SOE is an important one, and we need to unpack that. We need to get into a little bit more detail around the role that SOEs plays and what impact their functioning has on economic growth. And I think for me as well, the issue around, you know, Transnet in particular, and the impact that Transnet's ability, or maybe perhaps the lack thereof, to function effectively and promote movement of goods from point A to point B, which essentially is economic activity. And for that to grow, that will require a lot more discussion. So maybe, Nadir, if we hold on to the SOE discussion and the Transnet discussion in particular, and we just stick to the idea of economic growth insofar as the budget deficit is concerned. Your commentary on your view on the finance minister addressing the issue of the budget deficit and how do we cut the budget deficit and how do we move from there?
Yeah, so I think the solution we've taken in the shorter term to kind of cut the budget deficit has been a combination of two things. It's been, one, drawing down on the contingency reserve, and two, being pretty frugal on spending outside of the big ticket item, which was the civil servant wage increases. So outside of the civil servant wage increases, which was a big number, they've been pretty frugal on increase in spending elsewhere. We've said it now a number of times, no more money, no big money for SOEs, no massive increase in social grants, no real big ticket items. I'd say the two big things was the civil servant wages, and the other one was the investment in peace and security. I think the number he gave was 765 billion, was it? Yeah, 765 billion, and that was, they're going to recruit 10,000 police officers. But again, that's that's spending versus investment. That's an investment, right? Yes. Because at the end of the day, if we want to create an enabling environment to unlock investment, you got to have safety and security. Crime's a big problem in South Africa. You're gonna discourage investment. If you have crime. So I think from a budget deficit perspective, the view that is taken in the short term is to be pretty austere on the spending, draw down on the reserve. But we keep saying it: 1.6%, 1.5%, 1.6% economic growth in the medium term just isn't enough. At some point, we're going to need that growth number to come through, and that's going to be the only way that we can sustainably cut the budget deficit and then start to reduce the debt to GDP ratio. We're talking about it stabilizing around the 76% level or just above the 76% level. But if we want to see that being cut aggressively, let's not forget in 2008, South Africa was a 35% debt to GDP economy, right? That number is more than double. So, if we want to start to see those numbers, so if we're talking specifically about the deficit here, if we want to see those numbers being sustainably cut, the only silver bullet is we have to manufacture growth in this country.
Yeah, so again, context matters in every single sense, right? Let's rewind to last year's budget speech, or rather just the year in general. The government almost got a little bit lucky, if I can phrase it that way, in that there was a tax windfall coming out of the mining sector, which was a real buffer to a lot of, and enabled and afforded the finance minister the opportunity to make decisions based on that windfall. We've now come to the end of that so-called super cycle within the mining sector, right? And mining tax revenue has gone down by about 50%.
For two reasons, by the way. One, the commodity cycle is turning globally, but two, Transnet has scored some own goals, right?
So you can't
doesn't help if you can take out all the minerals you want from the ground. If you can't get from mine to port, it's not going to help.
Exactly. Yeah. So we have double whammy upon double whammy, unfortunately, right? And so we don't have the revenue that would have come, or that did come last year, so this year there isn't that. And almost one suspects that the drawing down of the reserves from the Reserve Bank, and we need to talk just for context for the students and public who are listening online, just a little bit more about exactly what the contingency reserve is. And in many ways, you could probably phrase it, and you'll talk more broadly on this, but you could probably phrase it as money that belongs to the government that's managed by the Reserve Bank, that is meant for, I don't know, you could probably even say a rainy day, you know. And some may argue that we're in a rainy day, and so it's natural to take money out of the reserves. What's the point of having reserves if you don't use it when you need it? The problem being, you can almost see the drawdown of the contingency reserve of 150 billion rand, your nest egg essentially, to cover for the loss of income from the mining sector, which basically we don't have anymore, right? So that's a bit of just context around what you mean by cutting the budget deficit and the drawing down of 150 billion from the contingency reserves. So we're setting that context. Then the wage negotiation for the public sector wage bill, which is to many already far too inflated in the first degree. With the fresh agreement in place, probably about last year, I think it was, when a new wage agreement was signed, there's further pressure on the finance minister. And Kanyari, maybe that's where we need to take this conversation. If the two drivers, as Nadir has put it, of managing the budget deficit happens to be the drawdown of 150 billion from a contingency reserve, which we've loosely defined as what it is, and you can expand on that. And if the other flip side or the other driver of that is the inflated public wage bill, how sustainable is this? Where to next? So the question then is, in next year's budget speech, are we going to draw down again from our reserves until the reserve is over, and then what happens? Because I don't see anywhere in the economy another equivalent of a mining super cycle that can help us through these tough times. So just your comment and your sense of what the sustainability is, and if it's not sustainable, then where to from there?
Sure. I think let's first just give a bit more color on the reserve account, so called the GFECRA, so it's the Gold and Foreign Exchange Contingency Reserve Account. As you rightly say, essentially the Reserve Bank manages it on behalf of Treasury. The balance ballooned to about 500 billion rand. That's in the positive over, call it, the last 2 decades as the rand depreciated. So what it is, it's actually an account of the unrealized profit or losses, in this case profits, on the movement in gold and your rand reserves, essentially. Yes. So just to also provide color, that I think Treasury and the Reserve Bank are at pains to stress is that what you're not doing is actually selling down reserves. You're not drawing down and reducing reserves at all. The way they're implementing it is to actually what they call monetizing. So essentially what you're going to do is print the requisite amount that the Treasury needs, and then what you're going to do to essentially prevent that from being inflationary, you're going to withdraw that liquidity from the system. Essentially, you're going to issue some securities, some short-term securities, and the financial system essentially will buy those, and then essentially you offset that liquidity that you created by printing that money. So I think it's very key to mention that point. And secondly, part of the reason that it's taken a bit of time is that between the Reserve Bank and National Treasury, they want to make sure that there is a legislative framework for implementing it, and essentially that should ensure that in the future, should the people in power, or the people heading those institutions not necessarily have the same conservatism or the same discipline, then they're not going to necessarily decide on their own, on an ad hoc basis, how to draw down on that account. So the legislative framework has to be in place. So I think the key point to make is that I think the implementation of it looks likely that it's going to be quite responsible. So that aside, to your point about you draw down on it, essentially you've got the 500 billion, 150 billion of it is going to go to Treasury, and additional or a separate 100 billion goes to the Reserve Bank to ensure that you actually are incurring the cost, you can pay for the cost of that liquidity management process. So essentially, then you've got 250 billion, and you've got 250 billion, circa 250 billion remaining. So then what the question you ask is, what happens in the environment where the rand actually appreciates? Is the potential that you could actually wipe out all of those reserves, and then you end up in a position where now you don't have any buffer at all. But I think the work that they've done is comforting that buffer is actually perhaps sufficient to take that into account. But so it speaks to the point of do you have capacity then to be drawing down on it on a yearly basis? The framework they've put in place is that of the 150 billion, they're going to do 100 billion now in this first year to March 2025, and then they're going to do 25 billion in the outer 2 years, in each of the outer 2 years. So certainly the plan for them is not that
where do you have?
they are going
But I
to...
did search the web for it.
Sorry.
That's weird. Let's switch off Siri. Sorry about
No
that.
problem. So essentially the point that they making, or at least their guidance is not that the plan is to, on an annual basis, be drawing down an equivalent 150 billion. So I think from that point of view, certainly you're not going to have that windfall coming through every year. So to the point about the sustainability of your wage bill, etc., I think of some comfort. It is not necessarily great, but I think from a credibility point of view, it's helpful. At the MTBPS last year, October, the budgeted growth in your compensation of employees, your wage bill, over the medium-term framework is about 3.5%. So call it a percentage point below where the midpoint of your of your target inflation is. And in this budget now, they've adjusted it upwards to about 4.5% over the medium-term expenditure framework. So arguably, it's more realistic, and it sort of sets, I suppose, a ceiling on sort of the risks. Obviously, the question is whether your public servants and the unions will essentially just be happy with an inflationary increase, or we want something above inflation. But I think, at least from a credibility point of view, it is more realistic going forward. But I don't think you're going to, essentially from a budgeting point of view, you cannot always be relying on one-off things or cyclical things, whether it's mining sort of super profits or a GFECRA drawdown in 1 year. You have to have a sustainable framework where, regardless of the essentially the economic cycle, granted it does play a big impact, you try to essentially maintain your fiscal metrics in a balanced way that essentially ensures that you have fiscal discipline. So yeah, to answer your story, it's going to be tricky beyond sort of the ones-off that you've seen outside of the growth that we mentioned. Growth is going to be absolutely crucial to essentially make sure that you don't have any of these concerns about some ones-offs dissipating from 1 year to the next.
You know, Kanyani, as I hear you talk, it's uncanny how you've unpacked a complicated issue and made it accessible to a student and to somebody from the public. Because ordinarily, you may have heard the speech or watched the minister give a speech. You may have even heard some commentary sort of on the radio or on TV or elsewhere. But you may not understand the detail about how disciplined and the framework that you referred to that is being put in place to ensure that the 150 billion is not just being extracted out of, it's not like an EFT that somebody's sending from point A to point B, right? There's a process, there's discipline involved. And again, I'm not sure whether how strongly that would have come across to the average Joe public. You know, so I really must thank you for doing that. And speaking about the audience, I'd like to remind you online, use the opportunity to get involved, both in person as well as online, join the conversation, and put our guests to the task in terms of further analysis on the budget speech. Anything that makes sense to you and you want to comment on, go for it. If something requires a bit more clarity, you're more than welcome to raise those with us. If I come back to sort of the big ticket item then around tax. In any budget speech, tax is probably one of the first things people want to know about, right? And again, maybe we will stress the issue, we are in an election year. So, you know, hypothetically, it would have been easy for the minister to have, I don't know, even cut tax as a means of saying to everybody, this is the kind of government that we are. And there was a resistance of that, which is credit to the minister. I think that shows maturity in the leadership, understanding of his role. There's some issues around corporate tax that came out, especially when we talk about outbound businesses doing business elsewhere in the world. But Nadir, maybe kick off the segment around tax holistically. We'll get to personal and corporate tax in a second, but just give me your sense of what did you think the tax component of this particular budget speech meant for you?
Yeah, so I mean, I think it was, again, he had very little to work with, right? So I mean, we keep talking about this, but like and we keep reiterating the point, but growth is such an important aspect of all of this, right? Because you got two ways to increase tax. Either you grow the economy and you keep tax rates where they are and you collect a whole lot more tax revenue. So for example, if you're growing the economy, you create more jobs. This is the most simplistic example. We got 32% officially unemployed people on the narrow definition. All of a sudden, I mean, let's say by some miracle, and of course it's not going to happen, but let's say by some miracle we employ half of those people tomorrow. 7.5 million unemployed people. Let's say we create the 5 million jobs that allegedly the NDP is supposed to create. Let's say those 5 million jobs are created tomorrow. Those people are going to start earning a salary, they're going to be taxed, they're going to start spending money at the shops, they're going to pay VAT, all the rest of it. Yeah. So you cannot lift tax rates by a single percentage point and you're going to collect more tax revenue. That's the one way. South Africa has zero of that, right? We have 0.6% economic growth for 2023. We have 1.2% economic growth forecast for this year, 1.2, 1.3% forecast for this year. We are not getting more tax revenue by the economy growing. Simple as that. Okay, so, and then the other way is to increase tax rates, but at some point when the economy is very weak, that can be counterproductive, right? If you increase tax rates in a very weak economy, you could end up with a situation where you actually reduce the amount of tax collections because you increase the economic hardship, right? So if you have to increase the corporate tax rate, arguably they lay off more people. You know, if you increase the personal income tax rate, people have less money in their pocket to spend, right? The multiplier effect through the economy is less. So I think with very little to work with, the minister did a good job. I mean, there's certain elements in there, of course, we won't like. And again, he deserves credit for doing that in an election year. So one of the big things that he did that we possibly won't like is there's no inflationary adjustment to the personal income tax brackets. So this year, your employer is feeling particularly generous. They give you an inflationary salary increase. You get let's call it a 5.5 or 6% salary increase. You are going to pay more tax because he hasn't adjusted the bands upwards to accommodate for that inflationary increase. So by not adjusting the bands, that in and of itself is going to give him an estimated additional 16 billion rand of tax revenue over the next year. So that's been a good thing. But now, the biggest problem has been obviously we mentioned it a number of times, the amount of tax being paid by the mining sector has halved, right? Literally gone from roughly 80 billion to roughly 40 billion, give or take a couple of million. So that's 40 billion in lost revenue. The manufacturing sector, we continue to bleed jobs there. We continue to those companies are, continue to take a lot of strain. So we got reduced tax from the corporate taxes from the manufacturing sector. So a lot of the gain that we got, or in fact even more than the gain that we got from the brackets, not adjusting for the inflationary brackets, is being offset by reduced corporate tax rates, which then comes to the multinationals that you referred to. So any multinational operating in South Africa, irrespective of where the profits are booked, must pay a minimum of a 15% tax rate, right? So Treasury expects that, we were chatting just before we went on, that's going to give estimated another 8.5 or 8.6 billion rand over the next financial year. So I guess what I'm trying to say in a very long-winded way is that he is trying to offset the impact of a very subdued economy where the tax pool is not growing through kind of more innovative ways of multinational tax, of not adjusting the brackets, of kind of subtly, even though it didn't increase the fuel levy, the CO2 emissions tax went up. So, that's going to indirectly impact the fuel price and raise a little bit more revenue in taxes. So he's tried to be like, sneaky has a negative connotation. I wouldn't say sneaky, but he's tried to be a little bit more, a little bit more smart in terms of how he raises that additional taxes without overtly increasing the tax rate.
Yeah, and again, Nadir, in very much the same way that Kanyani had taken a complex issue and made it accessible, I think similarly this issue about, the headline would be no increase in tax, right? That would be the in personal tax, personal income tax, right? That would be the headline. But the backstory to it about not adjusting the brackets and the so-called bracket creep is not something that Joe Public would have been aware of necessarily. You would only know it through analysis. And I think that's sort of the value in the point that you made. And Kanyani, we speak a lot about, in the opening set of remarks, we said that what is transcendent, what is persistent throughout every issue in the budget speech is the issue of economic growth. And it sounds like you're belaboring the point, but it's just so fundamental for anything else to happen that you can't run away from it, right? So we look at two things then. I mean, it's been touched on. Number one, mining industry, tax revenue down by roughly 50%. Manufacturing industry down by, what's it, 10 billion in terms of revenue for the government. Where, if anywhere, is it visible for us to see where we can compensate? So if you're losing on those two big parts of our economy, where in the economy are we plausibly going to, outside of what Nadir has said, using innovative techniques, corporate tax from revenue generated outside the borders of South Africa, not adjusting brackets, those are all tactical, smart, innovative. Where would we domestically and legitimately so-called contribute towards the growth of the economy? I don't know. I can't see anything clearly staring me in the face, Kanyani.
It's very difficult to see that in the current environment. One of the slight positives from last year with the renewable sort of energy story was that obviously as the government allowed investment. You saw quite a lot of imports, basically a big push towards renewables, solar, and all of those things. And essentially that generated like quite an industry on its own within the local economy. And then to some extent that did help a bit to that 0.6% GDP growth last year. But obviously that is not enough. And obviously then you also have a sort of, it creates a base and it's difficult to sustain it going forward. But outside of sort of that, for the economy as a whole, more broadly, yeah, it's difficult to see where you essentially can get sustainable sources of tax revenue, sustainable sources of growth. You're just going to have to see that we're going to have to wait and see for the structural reforms to take place, and essentially then whatever that brings, where the cost of doing business is lower, where you can get your staff onto trains, to the ports, where electricity generation is sustainable. Once all of those things are in place, then essentially you've got your entrepreneurs, you've got your people on the ground happy to invest and put their money into SA and put it to work, and hopefully foreigners as well from the FDI side. But I think until that happens, it's going to be quite difficult to essentially get that corporate income, income tax coming through. Yeah.
Can I throw the cat amongst the pigeons?
Please.
So I mean, I've got there's a really out there theory, right? And I mean, South Africa has as bad as load shedding has been, and as bad as Transnet has been. I think we have if we get things right, and I'll say it is a big if, but if we get things right, we have the opportunity to be massively counter-cyclical. Okay, so the global economy is slowing down this year. Interest rates have been hiked globally for a long time. We obviously know a lot of the issues that China are going through. We saw it in the stock market last year. We saw it in the economic performance last year. So a lot of our trading partners are definitely on a slowing growth trajectory. And interest rates there globally are set to come down quite a lot in response to a massive. In fact, the conversation happening globally is that are we going to have a soft landing or a hard landing kind of recession globally, right? South Africa has the opportunity, because we scored so many own goals, we have the opportunity to actually be counter-cyclical. If we can get electricity generation right, if we can get the logistics sector right, if we can get some sort of structural reform right. I think that a lot of, I read an interesting piece the other day that individuals in South Africa are sitting overweight cash to the tune of 600 or 700 billion rand. Now, if we can create a more certain environment in South Africa and we can get that structural reform going, we could potentially see a significant unlocking of that domestic investment into the South African economy, right? So, at a time where foreign direct investment is a little bit uncertain because the global picture is not that great, and when the global picture is not that great, people are not rushing to allocate to emerging markets necessarily. So, and if they are allocating to emerging markets, the unfortunate reality is that for all the reasons we know, there's a number of emerging markets that are higher up their priority list than South Africa. So we have an opportunity to unlock a massive investment drive locally. And I think the other point to be made is that JSE-listed companies are under tremendous pressure to grow their earnings. They've had low ratings for a long time. If you look at us relative to some of our emerging market peers, particularly India, or our developed market peers, where the gap is even bigger. I mean, the equivalent company is probably trading on half the rating. So people are very uninspired by our companies here. But so they're going to be forced to invest for growth at some point, right? To manufacture that earnings growth and kind of realize all this value that's trapped there. So if we can get some of the structural reform right, if we can get some basic things right, South Africa has a massive opportunity to be counter-cyclical from a growth perspective. But I do caveat it on, it's a big if. It's a big if we get the structural reform right.
Yeah, so I suppose then that's the opportune point for us to enter a discussion on SOEs, Kanyani and Nadir. Because, Eskom in and of itself, the sustainability financially and otherwise, so too in the case of Transnet, is highly dependent. I mean, for me, it's not about whether or not Transnet and Eskom are profitable. I don't think that should be the goal, by the way. Because
Absolutely.
I think that if that is the goal, then
I concur with that.
we're overpaying for something
100%,
as consumers. So for me, it's not about the profitability of these organizations, but it's about the financial and otherwise sustainability of those, right? And if you just zoom out ever so slightly around what the impact of load shedding has been, at least to the layperson, you see a lot of solar panels on roofs at companies, homes, and elsewhere. And that doesn't seem to be stopping. That just seems to be carrying on every year. Which means that a lot of the generation capacity that Eskom would have been required to generate is now being taken on by people and organizations, companies, and the like. Which means there's a little bit less pressure on Eskom in that particular sense. So if the public sector broadly, I beg your pardon, if the private sector broadly was not putting up as many solar panels and other sort of generation capacity, we wouldn't be in a stage 6 load shedding, we'd probably be in some higher stage.
100%.
Exactly,
Right?
yeah.
So that's Eskom. And my question to you then, perhaps, Kanyani, is around this issue of the sustainability of the organization. If we're seeing a continued trend of private sector, again, whether it be personal or corporate, private generation of capacity for electricity and for power, where does that leave Eskom over the short, medium to long term in their sustainability?
Yeah, sure. I think in the short term, I suppose because the quantum of the renewable side, especially on the private generation side, is not that much, perhaps not as much a risk, but I think medium to longer term, certainly you have demand that's going to be destroyed and destroyed forever in terms of on the Eskom side, because essentially just shifts permanently to the private sector. And I think just to give an insight or two on the sort of listed property side, which I look at
Yes.
in quite a bit of detail, since the announcements last year, you've seen a very massive investment by these companies, the listed companies especially those that own shopping centers, because they've got all this roof space, and essentially you put a whole lot of solar panels there, and you're able to generate for your own consumption, you generate for your tenants, and as a result of that, you actually save a lot by not necessarily taking the power from the grid. And sort of added to that, and also related to the insights from these property companies, that it's not just Eskom that basically is affected negatively by this shift. Municipalities make a lot of money
Correct.
from
From
essentially
selling
on selling electricity. So
It's a scaffolding effect.
Exactly. So you've seen that basically also shift, and then municipalities in turn already under pressure from a revenue perspective, and then what they do is then essentially just to hike rates at a rate that's not in accordance with essentially the valuation of the property. So municipalities, as a result of this, not just Eskom, are actually reacting negatively and trying to essentially then try to get revenue in other ways. So it's not just Eskom that's going to have a problem going forward. Other areas of the state, especially of the public sector, are going to experience problems related to the fact that essentially one of your big revenue drivers essentially has disappeared, and the private sector is able to get it on its own. But I think on a net basis, it's just one of those questions, like essentially you've got this thing, Eskom might struggle longer term as an entity given that, but if you've got a resilient economy that essentially has these diversified sources of energy, perhaps from a growth resilience point of view, it might be helpful for the greater good of the country, I suppose.
Yeah, it's
Can I-
interesting. Yeah,
Can
sorry,
I,
Nadi.
can I add something
Yeah, of
there?
course.
So, I mean, we've spoken a lot about, so I mentioned the argument about being counter-cyclical, right? If we want to be counter-cyclical, we have to create a conducive environment for investment.
Yeah.
You're not creating a conducive environment for investment if my municipality wakes up one day and says, I'm hiking tariffs by
Exactly.
property tariffs by 35% tomorrow.
Yes.
Who, of the listed property companies you cover, which one of them are going to be lining up to build more space if they tell them we're going to be increasing tariffs by 35%?
Yeah.
So, the problem with, the issue we're facing at the moment is that the rot was left for so long. I have sympathy for municipalities because they do have genuine revenue challenges, but there has to be, I think there has to be a collective solution where, it can't be as blunt of an instrument to say, okay, I've got to make up for it somehow now, because that has other disastrous consequences, because you're going to keep on this negative virtuous cycle where if you hike property tariffs by that amount, you're going to get less and less and less investment. You're going to become you're going to decay more and more and more, even to the point where your municipality is not going to be sustainable in any event. So I think, these are some of the arguments where we're going to have to come up with more innovative solutions. And yeah, I mean, at the end of the day, we do have to have sustainable electricity generation. And we just got to think about innovative ways around how we work around the negative consequences of moving away from Eskom. But it can't stop the pace
Yes.
of creating energy resilience.
Yes.
They have to happen concurrently. That's just the reality.
And here's the challenge for people in this country, and we probably know somebody who talks this way. I'm going off grid, and so I don't really care about Eskom, nor do I care about, I'm going to look after myself. That mindset doesn't help based on the discussion and the points that you guys are making, because they'll feel it eventually through a long-winded way, and because of a scaffolding and downstream effect of Eskom's lack of sustainability or lack of obvious sustainability. It will be seen at the municipality, and the municipality will hike their tariff and their like you said, give an example, 35% hike in your, what's the word I'm looking for?
Your
Your
rates
rates.
and taxes.
Yeah. Silly word. Yeah, a hike in your rates, and you'll feel it that way. So you cannot divorce yourself from you cannot live in a cocoon.
No.
And I think too many people are falling into that trap.
100%. So this is the other thing. As South Africans, we have to accept that we are in this together. Just because I can afford to put solar in my house doesn't mean I'm immune from this problem.
Exactly.
The other way it's going to come back to bite us is that we're going to end up with a massive 500 billion rand bill one day if Eskom is not sustainable, because if we default on that Eskom debt, technically the sovereign enters into it, has to cover that, right? So, and the sovereign has to cover it. Well, the sovereign only makes money through taxes,
Tax.
so we're going to pay for it in some way.
Yes.
So, we're all in this together, and we have to find innovative ways to solve this together. Just because I've got solar at my house,
Correct.
it's not
Correct.
going to, I'm not immune to the problem.
Correct. So burying your head in the sand is not the solution, essentially. I want to get to Transnet in a bit, but I just want to sort of close out this discussion on Eskom, and its potential sustainability. Large corporates would ordinarily be paying Eskom and for the services of power generation in a normal sense. Because of load shedding, those large corporates who are big customers of Eskom are now no longer big customers of Eskom. They may still have a reliance on Eskom to some degree or another, especially maybe not in the energy generation, but certainly in energy transmission, and in that sense, they may have a reliance on Eskom, right? But revenue-wise, it's going to start drying up. If that dries up, in much the same way that tax revenue dries up, here it's a state-owned entity where their income is being dried up. That again poses a fundamental and existential risk to Eskom, which is something that, as you point out, we cannot afford to do, right? So it's in everybody's, but maybe the point that I'm making before we close out the loop on Eskom is around the fact that Eskom's existence will probably not be fully at risk because of the fact that most people or most entities will still need Eskom for transmission of energy, even if it's not for generation.
100%.
So I think there's kind of, maybe it's a silver lining in this Eskom discussion, Kanyani. But let's move on very quickly to Transnet, and maybe we'll close on some fiscal outlook. and then we'll open it up to some questions, right? Transnet, and you can correct me if I'm wrong with my statistics, but somewhere along the line, Transnet has indicated a need for roughly about 150 billion rand. And that was sort of overtly expressed, right?
Yeah.
Again, you can debate the merits of why they need that money and whether it's justified or not. It is what it is for now. I don't know if the finance minister had expressly addressed Transnet and that need of 150 billion as a line item in the budget speech. It may have been implied in some other parts of the speech, but maybe I'll bring the question to your door, Kanyani, around what would be the reasoning for not addressing something so fundamental to Transnet and the movement of goods in the country and addressing the challenges faced by Transnet?
Okay, let me start by saying Transnet's challenges are quite varied. I think you saw towards the end of last year they had quite a shake-up on the executive management side, and I think that was a first step in essentially addressing some of the governance issues that the entity had for quite some time over the years. So to the figure they sort of requested from Treasury, there was some letter they wrote. I think explicitly they sort of referred to a figure of around 100 billion, and of that essentially they have a maintenance backlog equating to about 55 billion rand of that. So they need to actually get money to address sort of maintenance issues along the track, the locomotives, and a host of other things. But what we saw after the MTPS, but before the budget, was that sort of on the 1st of December, Treasury sort of communicated that they had made available to them a guarantee of about 47 billion, and they will be able to draw on that subject to some conditions similar to essentially what you saw with Eskom. So I think this point is important, that unlike in the past, and I think you saw it already when Titombo, when he came through as finance minister, that this approach where in the past you just sort of gave, whether it was SAA or the Land Bank or whoever, like just cash transfers without conditions.
It was like a freebie.
Yeah, those freebies are over,
Yes.
and you saw that with Eskom last year, and then I think the Transnet story as well. They want to see self-help measures. They want to see third-party sort of participation as well by the private sector. So given that the 47 billion was spoken for in December already, I think essentially it allows Transnet to have enough liquidity, I think, over the sort of the short term, essentially to not necessarily need something as imminent as the 100 billion that they requested. But I think, say, over the next year or two, something is probably going to have to come back to Treasury, because essentially you still have to address the core issue that they've got 130 billion of debt, and over and above the guarantee you've given them, you essentially need to put them on a similar path, essentially to Eskom, where there's actually comfort that the cash that they need is actually there. So the reference to Transnet was very minor in the budget, and it related to that guarantee. And I think, yeah, on a sort of medium-term point of view, we're probably going to see a transfer, but I think the point around conditionalities is an important one, and I think it's a welcome move from essentially the previous years where they were just freebies. Yeah.
Yeah. So I think, again, there's discipline in the way that the minister is dealing with Transnet.
Yeah.
There's structure. There's a framework and process that needs to be followed. So the fact that he didn't spend too much time talking about Transnet in and of itself doesn't mean Transnet is being ignored.
Definitely
It's
not,
simply
yeah.
a case that it's being dealt with elsewhere, and there's no need to spend too much time in a budget speech because it's work in progress.
Indeed, yeah.
Indeed, right?
Yeah.
Nadir, let's maybe move towards a final point, if I may, before we open it up for questions and answers. Around fiscal outlook, what is the prospects and what's the state of play in terms of fiscal consolidation? How are we doing in that regard? I don't know if it's necessary for us to go into a discussion around, rating agencies and the like, and the impact of the budget speech on what it might do for ratings agencies. I know for many people, the ratings agencies is like a major indicator in terms of the health of the economy. Just your sense of fiscal consolidation, where are we on that, and where to from here?
Yeah, okay, so I'll be quick. So I think on fiscal consolidation, we're doing well with how little growth we have. So it's set against, obviously, a disappointing and a tough backdrop. So let's start there, right? I mean, the bottom line is that debt stabilizing at 76% of GDP is not a good outcome in isolation. but given where we've come from,
not as
and given
bad
the
as it could have been.
challenges, it's a lot better than it could have been. And we're committing to fiscal consolidation, and that number remember that at the medium-term budget policy statement last year, there was talk about that number going well north of 80%.
Yeah.
I mean, that, like a real runaway debt scenario.
Yes.
So we've managed to curtail that, which is a very good thing. From a ratings perspective, I think that's quite ratings positive, but ratings positive needs to be taken in context, right? I don't know if it's enough. It's probably not enough to start talking about ratings upgrades to positive outlooks or ratings upgrades altogether. Ratings agencies are certainly going to want to see, first of all, delivery of that consolidation, but secondly, are certainly going to want to see more than tepid growth before they're even willing to have the discussion around ratings upgrades. I mean, I don't know if you,
Yeah,
I don't know if you'd agree with that.
Yeah, absolutely agreed. I think one point to add that I think the ratings agencies would also like is that what was highlighted in the MTBPS, and there was a bit of color on it in the budget today, was the issue of a fiscal anchor or fiscal rule. So essentially, to put it in very simplistic terms, think of having GPS in your car. You say, I want to drive from Joburg to Pretoria. Should you wander off and end up in Boksburg or in Krugersdorp, the GPS says you're off track,
Bring you
go
back.
back on track. So there wasn't necessarily a long-term one. They still, similar to sort of the GFECRA thing, they want something anchored in legislation to basically make it binding and formal. However, in the meantime, they've just committed that they're going to have sort of a debt stabilizing primary surplus as the goal, and that's supposed to be then the guide for you to essentially make sure that you are on track and you don't veer off. And hopefully, in the not too distant future, we'll get something that is a bit more formal and legislative that will actually make the budget process a bit more credible going forward.
Excellent. Maybe we should close out this issue of fiscal consolidation, just connecting it to a point that we made earlier, right? So the 150 billion contingency reserves drawdown, how much of that is going to be used to manage debt in the country? How much of that is going to be used to further manage the 76% debt to GDP ratio and the like? Just so that everybody who's watching and listening online and in person has a good sense of what that money is going to be used for.
Mm. So look, a chunk of it is good. So, okay, let's start by saying this. If there wasn't that facility available to draw down, we would not have been consolidating in 25-26 at just above 76% debt to GDP. I forget the exact number. It's just above 76% debt to GDP. Yeah. So we would not be going there. We'd be going above,
yes,
well above that.
80%.
So a good chunk of that is going to, keeping that debt to GDP ratio in control. So not adding to the debt bill, but then also a fair chunk of that. Remember, the additional spending on the public sector wage bill is something like 250 billion over a 3-year period. So a big chunk of that is also going towards. So look, I'm not sure of the exact numbers. Maybe you can shed some light. But what I would say is that of the 150 billion, there's a part of it that's going towards ensuring that the debt is not adding new debt, and there's a portion of it that's outright going to be spent by going to public sector civil servants in the wage increases that they've penciled in over the next.
So maybe the way to frame it then is that the 150 billion drawdown is not necessarily going to reduce debt, but it's certainly going to ensure that debt doesn't increase. Maybe it's going to just be flat-ish.
Yeah. So or debt is going to meet what the Treasury
target
promised in the target.
Right.
Correct.
Yeah. To put it from a different angle, obviously you've got a deficit. That essentially your shortfall, and then on the other side, the way we fund it is to essentially issue debt, government bonds,
yes,
T-bills, etc. So to look at it from the funding side, the practical side of it is that you've got 100 billion, I think, as I mentioned earlier, this year 25 billion in the outer 2 years. So essentially that 100 billion that you get from the GFECRA means you don't have to issue as many bonds this year,
yes,
and similarly your funding requirements for the next 2 years also reduced by the 25 billion as well. So it essentially helps, and it's quite positive for the bond market in the sense that you limit the supply of your debt in the markets, and as a result of that, you can arrest your borrowing costs, essentially.
Thanks, Kanyani. Nadir, I think it's an opportune time for us to maybe head to our in-person and online crowd and audience to maybe take some questions. I think if somebody's got a question online, they may unmute themselves, I beg your pardon, but if it's on the chat, I'm going to ask one of my technical team members to maybe just read the question out to the panel, and then we'll field it from there.
Thank you, Dr. Patel. This is a question online. South Africa is known as a social security agency. How long will it sustain itself as per the 4 trillion rand debt that they have indebted, that they are indebted? Where will they get more fiscals to increase social grants? Moreover, inflation rate has raised its ugly head of tormenting the middle class.
Thank you.
So
Thank you. I think we get the gist of the question. I think there's a bit of a tongue-in-cheek comment at the beginning that South Africa is a social services agency. But I think if we get to the meat of the question itself, I'm not going to pick on either of you. Maybe one of you can volunteer to field part or whole of that question. Let's go to you,
Yeah,
Nadia.
okay, so yeah. So look, I mean, I think, so about inflation rearing its head, you know, it's really a double-edged sword. So the question, I'd like to pose a question back to the person who asked that question and say, I mean, would you be comfortable with inflation coming lower if the Reserve Bank kept interest rates where they are and your mortgage payment and your car repayment stayed as high as it is, right? Because that's ultimately what it takes to keep inflation in that band. We've got to have very disciplined monetary policy, which our Reserve Bank has been quite good at doing. So, you know, the inflation argument is that we want to, exactly for the reasons you've mentioned, is that inflation hurts the middle class the most. We spent some time talking about food inflation, I think, just before we went on air, and that's what really hurts the middle class. But to keep inflation in check, we have to keep interest rates high. You know, that's unfortunately the cost of it. And, you know, our Reserve Bank have been fairly disciplined about that and are quite renowned globally, actually, in being very disciplined monetarists. And the Secheg and Jaco has actually built a lot of credibility globally for doing that. In terms of the amount of debt, again, you know, drawing down the contingency reserves, the fiscal sustainability, we chatted a lot about that. So I think they are trying to stabilize debt at in and around that 76% level. You know, in terms of really starting to tackle that beast of indebtedness, we've got to get growth going. And we've chatted a lot about growth on this panel as well. So, I mean, those are kind of the high level comments that I'll make.
Sure. Kanyani, anything to add to Nadia?
Yeah,
This one?
I think I'll just touch on the social grant issue. I think 100% that obviously the number of grant recipients is not ideal. Ideally, we'd want people actually in gainful employment rather than getting grants. And you saw in this budget and from the MTBPS as well, the SRD grant, the former COVID grant, was extended to March 2025. And essentially what it sounds like is that it's going to become a permanent feature. And essentially what you're going to need then, which is not spoken for currently, is funding for it. This year, given probably considerations around the elections, you probably wouldn't want to do any increases in taxes, or especially in VAT because it's regressive. But going forward, there's going to have to be an explicit funding mechanism for that permanence in the sort of social relief of distress grant, the former COVID grant. So I think the number of grant recipients relative to the taxpayer base, we all know sort of those considerations around how unsustainable that is. But again, it comes to growth. If we have a growing economy, then you don't necessarily need such a big sort of welfare check going to people.
Yeah, and I think that's probably the thing about a social grant in and of itself. Once you offer it, it's very difficult to take it away.
Yeah.
And that's probably what we're seeing with the COVID-19 grants, right? Like, okay, we'll try and sort of kick the can down the road to 2025, but people have become dependent on those grants. The original purpose or intention behind the COVID-19 grant has morphed and changed into something completely different, and people use it now as part of their bread and butter, so to speak. You know.
Correct.
So I fully take your point, Kanyani. I think there's another question online. I'm just going to ask my team to support me with that.
Yeah, there's actually a few questions, but I'm just going to pose a comment that was made on the grants. Somebody commented, and we're not asking for an answer on this one. And the comment was, let's do away with the grants completely. It's a waste of money, and apply it some other way and create jobs. So this is somebody's opinion. You know, I don't think we need a comment on that one, right?
Sure. Maybe let's go to the other question. We'll sort of bring it into the conversation.
The next question is, potentially redirecting and getting hold of domestic investment sounds great and all. I'm reading it verbatim.
Yes. That's right.
However, the government or the state has a culture of rewarding incompetencies and having no accountability whatsoever for bad decisions they make, while they continue to get richer, to say the least. How would you propose that accountability and competencies is ensured and adhered in order to get hold of the domestic investment? And that domestic investment is in inverted commas.
Thanks. I'll maybe preface the sort of answer, if I may, around this issue about the inverted commas of domestic investment and taking away from Peter to pay Paul. I think it kind of is it's a narrative that a lot of people tend to buy into, probably through, I don't know if it's the media or where do they get this. The source of information, I think, is the issue. Because to the examples that were made earlier, there are some seriously rigorous processes and frameworks in place to manage money responsibly that Joe public just doesn't know about, unfortunately, right? All they know is the headline about corruption, which is a serious thing. I don't think it's the intention is not to minimize the sort of sentiment and underlying drive behind those kind of questions, right? But I think it's important to frame sources of reliable information being kept informed in a way that is not going to result in negativity which breeds upon itself. I think there's a lot of, we have to balance the realities versus what is not hidden in plain sight. And like I said, we've discussed some of those processes and structures in place to protect and essentially prevent misuse and misdirection of funds. So I think that for me is a preface to before I invite the two of you to comment. Maybe that's just a nice way of sort of introducing the question in a different manner. And maybe Kanyani, if you want to go for it first, we'll then ask Nadir.
Yeah, sure. I think I share the sentiment that the person who asked the question sort of has. You need to see amongst the public essentially an appreciation that people who do wrong in society actually get punished for it. So we had a very lengthy, the commission, the Zondo Commission on state capture. A lot of recommendations were put out from there. There were a few arrests here and there, but nothing concrete that actually has said, these are the culprits from the state capture years, and this is sort of how they got punished. And I think you need, from a sentiment point of view, not just amongst the people, but I think from business as well, that if we are a country that says we believe in the rule of law, you have to see that apply, and you have to see people get punished for their wrongdoing. And I think there's a lot of work that needs to happen, I think especially by the National Prosecuting Authority, that you don't just arrest these people and take them to court, you actually need to convert them and see people being basically going to jail for a long time. And I think linked to that also, part of the reason we're grey listed, the issues around sort of the shortcomings we have sort of on the financial side, essentially that those money laundering sort of gaps, all of those things, we essentially need those things to be covered convincingly to actually restore the confidence for domestic investments to return.
Yes, certainly. Nadir, your thoughts?
Yeah, I mean, I wouldn't add much to that. Absolutely, we gotta see, the one place where we have been let down. I mean, there are the mechanisms being put in place, as you said at the start, but these are marginal metrics, and what I mean by marginal, I don't mean small. I mean
Yes.
new metrics that are being introduced for additional money to come.
Yes.
You can't get away from the fact that there's still depending on who you believe, somewhere between 1 and 2 trillion rand that was looted.
Yes.
We can't end 1 and 2 trillion rand that was looted when when we're in an economy in distress. You are going to have people that are angry, and the reality is that you do need to see convictions, and I think that's probably one part where we have been let down. So
Yeah.
I'd agree with those sentiments, and we do need to see some orange overrules if for nothing else, for that improve of sentiment, and to basically tell the world and to tell allocators of capital that there are consequences for wrongdoing here, and we follow the law. So yeah, I would agree with those sentiments.
And again, Kanyani is talking about sentiment. Sentiment leads to increased confidence, and confidence is the breeding grounds for growth of the economy.
100%.
Right?
Yeah.
I think just maybe again another silver lining out of the budget speech itself. The Finance Minister did speak about allocating funds to implementation of the Zondo Commission's findings and recommendations. So again, it's a signal to the public and beyond that we're taking this matter seriously. So I think it's important.
And 10,000 new policemen. So
I
hopefully we get some
see
law
you're quite happy
enforcement.
about that. Are there more questions
Yeah,
online?
Dr. Patel, we're going to ask one last question from online.
Yes.
And then we're going to go to the in-person.
Sure.
Right? Okay. So there's sort of two parts to this question. What is the panel's view on local industrialization and mineral beneficiation? And the comment to the question is, this was not covered at all in the budget speech and has the potential to grow SSGDP to unprecedented levels, irrespective of who is in charge of government.
Okay, it seems like there's a bit of a technical slant to that question. I'm not sure if either of you are going to volunteer to answer that question, but I think at least maybe let's try and again contextualize what's probably sitting behind that question, right? I read into that question sweating the assets and making sure, almost like to use the adage, African problems to African solutions. I think South African solutions to South African problems. I think that's probably in some ways what's being expressed here. I don't know the detail about it, but if either of you have a view, I think it's important we address this kind of thing.
Yeah, so I mean, I think I'll maybe, I don't know how helpful this is going to be. I'll maybe offer a more philosophical answer. Is that, there has not been an economic success story of the last 300 years that hasn't been based in an industrial economy. I think in the case of South Africa, my personal fear, and I don't know exactly, I mean, there's no science to this, but my personal fear is that I think the horse has bolted, unfortunately, when it comes to industrialization. When democracy came to South Africa in 1994, we basically opened our economy, completely free trade of goods and financial flows, by the way, and we opened our market completely to international players, both for movement of goods and services with relatively frictionless costs. If you look at the stance that China is probably the best recent example, they had massive protection of their local manufacturing sector going back to the 80s and the 90s when they built themselves up to become the economic powerhouse, the manufacturing powerhouse that they eventually ended up being. Now, South Africa, I mean, obviously they had a lot of, demographic advantages to do that. I mean, they had over 1 billion people, for goodness sake, So you're gonna have some demographic advantages to be able to industrialize there. But South Africa had its own set of advantages. I mean, we have something like 80% of the world's platinum supply, but we export it in its raw form. So I think to the person online's question, sorry, I didn't get your name, but to the question, we could be, for example, beneficiating the catalytic converter manufacturing industry in South Africa. Instead of just exporting the raw material, someone making a catalytic converter in Europe and then importing it back here to assemble it in a car. It doesn't make a lot of sense, does it? My fear is that I don't know, and I'll maybe pass the question on to you here, I don't know to what extent the horse has now bolted and we can implement those protectionist strategies now, given the very fragile sentiment towards the South African economy. So I think the time to do that was a while ago, and I don't know how implementable that is now, unfortunately.
Yeah, and maybe as we get Kanyani's view on the matter, like you say, protectionism might have an adverse impact on foreign investment. It might turn people away from the country. And maybe, Kanyani, as you consider your thoughts on the question, to complicate matters ever so slightly, people keep on talking about the 4th Industrial Revolution and even the 5th and 6th Industrial Revolutions. And for many who use those terms, they probably don't have a good definition of what that actually is, right? But it's a reality of where we are. And so I suppose that kind of muddies the waters even further in trying to address a question like this.
Yeah, so I think to also answer it a bit tongue-in-cheek is to say, why would you worry about, the 4th Industrial Revolution when you're struggling with, probably the first two,
exactly.
right? So I think some of those, it's good to have ambitions as a country. We shouldn't be happy with where we are, but I think let's get the basics right. You can try to get industrialized zones, but if you're going to tell them to be on load curtailment for so many hours of the day, to what extent are they able to compete with their peers in other markets where essentially you don't have those sort of own goals and those setbacks that you impose on yourself as a country. So I think it's a noble question, and I think it's something that we should strive for, but I think the key is that let's get the basics right. There are some areas we know essentially how big we are as exporters or assemblers of sort of motor vehicles out of the Eastern Cape, out of sort of Pretoria, and all of those things. Those are some of our strengths, and I think also that's key that we must play where we are strong.
Yes.
There's no use trying to essentially just compete for the sake of it when other EMPs are quite well ahead of us. And yeah, speaking to Nadir's point, like the horse has bolted in some areas, so yeah.
Absolutely.
We're not going to manufacture clothes cheaper than Vietnam. Doesn't matter how much we
Yes.
protect the local.
It doesn't matter what may have been the
industry.
case in the past. Or in,
Yeah.
you need to understand that you can't be all things to all, I suppose, all people in many
Yeah.
ways. Eh? Understanding what your strengths are and working towards them.
Exactly.
I think there's at least a question or two from the in-person audience, and I'd like to use this opportunity to invite that question now.
My name is Rudzani. I'm one of the DBS students at Regent Business School. If we go back a few years ago, we had an increase of 1% into our VAT. Can we today sit and we say we made a good idea, or was it a good idea? Was it, can we be proud that, it added value into the structure that we're trying to build in terms of the economy? In a sense that if we didn't have that 1% increase into the VAT, were we going into the doomsday, or was it something that we could have lived without?
Yeah, and VAT is always an interesting one. I think, when VAT was at in the good old days when VAT was 14%, it seemed to have been 14% almost for a generation,
Wow. Yeah, yeah.
if not longer.
Long time, yeah.
And all of a sudden, in fact, for a long time, VAT was a taboo. You don't go near touching the
Yeah,
VAT
yeah.
rate. You just don't do it. It's not something that gets done.
Yeah.
And then it was done. And then there was even talk of it being done again. Maybe the election year, I don't know, is what stopped it from being spoken about again more strongly, right? So I think that question is so valid, because once you do it once, it's easy to do it a second and a third time. And all of a sudden, you're not doing it once in a generation. You might be doing it once in a decade, or even more. So yeah, maybe the question more directly, did it save us from doomsday? Was that money allocated effectively in the economy? Kanyani, your thoughts?
Yeah, so I think on it, you have to answer it more holistically. You've got to look at Treasury's funding mix. So from a tax perspective, obviously, you've got corporates, you've got individuals, then you've got essentially things like property taxes, fuel taxes. So I think at the time when VAT was hiked, essentially it was at a point where essentially your room on the other taxes was probably limited, and you essentially say, I've exhausted this on all these other ones. The next step, and I think similar to now, essentially you're at a point where your individuals are maxed out. The pressure they're under to try to essentially increase the marginal tax rate is probably not feasible. On the corporate side, you actually reduced it by a percentage point the other year. So on that avenue, you also don't necessarily have scope to move. And on the property side, we've spoken about how essentially the municipality is under pressure. So as the central government, you probably don't want to add too much in terms of the other taxes that you get on that side. So then essentially VAT then comes through by default. But obviously then the key issue with VAT is that it's regressive. A lot, as Nadir mentioned earlier, you've got the poor spending a big part of their budgets on food, and essentially that VAT will hit them the most compared to other income groups. And essentially you're trying to be a country that sort of, I suppose, takes care of the poor, but you essentially hit them. They're supposed to be the beneficiaries with the tax. So from that point of view, it's probably a bit counterproductive. So I think to answer the question of whether the money then was used, like moving from 14 to 15, was used productively, I think the state we're in probably would argue that maybe not, given that essentially the trajectory has been in one direction. And going forward, yeah, to your point about whether we do move from once in a generation to maybe once in a decade, yeah, it doesn't seem to be the holy cow that it was in the past.
Yes.
Definitely. Yeah.
Absolutely. Nadir, any thoughts on the question? Anything to add?
Yeah, so I think the fact that it wasn't necessarily used that productively, because we don't see it necessarily in the fiscal consolidation numbers and the rest of it. And then when you combine that with the fact that food inflation, we were chatting just before we went on, food inflation came from double digits last year to 7.5% this year, and we've seen the biggest interest rate increases in a generation, the repo rate, the highest it is. Like the consumer is just getting like one hiding after the other, right? So you kind of feel the pain when you start to talk about the VAT increases, and then when you couple it with the fact that it could have possibly been allocated better. Obviously, it alleviates it exacerbates the frustration even more. In terms of going forward, yeah, I don't necessarily see that as a productive way of raising more revenue. I don't know if we can go the route of, because food inflation is a problem, and as long as we've got load shedding at least, and as long as we've got the rail troubles, and as long as the rand is as volatile as what it is, and that feeds through into food inflation, I don't see how hikes in VAT would be a viable solution. The only thing I could say is, like, let's create a conducive environment for investment. Let's get growth going, and then all of these become moot discussions. So I would say that ultimately would be the target for me. I don't see how we increase VAT further from this point. It could actually end up being counterproductive.
Nadir, Kanyani, I must thank both of you for your time, for your insight, for your experience, for sharing so generously of your expertise. It's been a lesson for me. It's been an education for me, and I'm sure for everybody online and in person as well. As I mentioned at the beginning, you are both part of the Regent Business School family. Specifically to you, Kanyani, I know Nadir has a seat at the table every year, and we look forward to hosting both of you again at future events like these, and specifically next year at our annual budget speech. Thank you very much for the time, like I say. Thank you to everybody online and to everybody in person. I hope that you've extracted the necessary value and you've extracted some kind of meaningful application to the way that you understand the economy and what it means for you in your pocket ultimately at the end of each day. But for me, in the Johannesburg studio and campus of Regent Business School, I'd like to thank you for your time, and I wish you all the best. Thank you very much, and it's bye-bye for now.